Imagine walking into your favorite neighborhood store, only to find the doors shut, shelves empty, and the lights out for good. That's the reality many Americans are facing with Big Lots, a retail chain once known for unbeatable bargains on everything from furniture to snacks. For decades, Big Lots was the go-to spot for budget-savvy shoppers hunting for deals. It wasn't just a store, it was a treasure hunt. But today, Big Lots is on life support. Store closures are mounting, bankruptcy whispers are turning into headlines, and a retail giant that once boomed is now barely hanging on. So, what happened? In this video, we'll uncover the real reasons behind the dramatic downfall of Big Lots. We'll break down how bad decisions, changing customer habits, online competitors, and financial missteps all played a role. But this story isn't just about one company. It's a case study in what happens when a retail brand refuses to evolve in a digital-first world. Stay with us, because what happened to Big Lots could happen to any business that ignores the signs. A quick history of Big Lots began its journey in 1967 under the name Consolidated Stores Corporation. It was founded by Sol Schenck in Columbus, Ohio. Schenck's idea was simple but brilliant: purchase closeout and overstock merchandise from struggling retailers and resell it at discounted prices. This bargain bin strategy quickly resonated with shoppers looking for value without sacrificing variety. Throughout the 1980s and 1990s, the company expanded aggressively. It acquired chains like Toy Liquidators and even KB Toys, broadening its footprint in both the toy and discount retail market. Consolidated stores became known as a place where shoppers could find everything from home goods to snacks at unbeatable prices. In 2001, the company rebranded all its outlets under a single, unified name: Big Lots. The rebrand was a fresh start aimed at building a more consistent customer experience. And for a while, it worked. Big Lots thrived, offering furniture, groceries, seasonal decor, and everyday essentials at discount prices. By the early 2010s, Big Lots had more than 1,400 stores across the United States and was generating billions in annual revenue. But behind the scenes, cracks were forming. Challenges in strategy, identity, and customer engagement began quietly undermining the business. The foundation was strong, but the future was about to get shaky. The downward spiral, one major factor that pushed Big Lots toward its current crisis, was poor timing with its investment in furniture. During the COVID-19 pandemic, as millions of Americans stayed home, demand for home improvement and furniture soared. Big Lots saw this as a golden opportunity and shifted a significant portion of its inventory strategy toward bulky, high-margin furniture and home decor items. They scaled back on their core offerings like closeouts and small everyday goods. Betting big on the furniture boom? Initially, the move seemed profitable, but by late 2022, things took a sharp turn. The pandemic-driven surge in home spending fizzled out. Most consumers had already upgraded their homes, and rising inflation made large purchases far less attractive. Suddenly, Big Lots was left sitting on massive amounts of unsold inventory: sofas, dining sets, beds clogging warehouses, and store space. To clear them, the company was forced to offer deep discounts, severely cutting into profits and eroding their already thin margins. Confusing. Brand identity: Big Lots found itself stuck in an identity crisis. Was it a discount store for everyday essentials, a budget-friendly furniture outlet, or a place for seasonal bargains and groceries? The company never clearly answered that question. As a result, its brand image became muddled. Some stores looked like exciting treasure hunts with unexpected finds, while others felt disorganized and half-empty. This inconsistency led to customer confusion and, over time, weakened brand loyalty. Online competitors took over at the same time. Online competitors were dominating the retail landscape. Amazon and Wayfair seized the furniture and home goods market with better prices, smoother logistics, and a vastly superior online experience. Even traditional giants like Walmart and Target had already invested heavily in e-commerce and delivery infrastructure. Big Lots, on the other hand, had a sluggish, outdated website and little focus on digital innovation. It simply couldn't keep up. Financial mismanagement. To make matters worse, financial mismanagement added fuel to the fire. Between 2021 and 2022, Big Lots spent nearly $400 million on stock buybacks, hoping to impress shareholders. But this strategy backfired. The money could have gone toward modernizing stores, upgrading tech, or strengthening supply chains. Instead, by the time economic pressures mounted in 2023, the company was cash-strapped, burdened with debt, and dangerously vulnerable. Deeper problems that made things worse: overexpansion. Big Lots expanded aggressively, opening to many stores across the country without fine-tuning its retail model. In many cases, these new locations ended up in markets already saturated with competitors like Walmart, Target, and Dollar General. Instead of capturing new customers, Big Lots ended up cannibalizing its own sales and spreading its resources too thin. This not only diluted its customer base, but also significantly increased overhead and operating expenses, adding pressure to already thinning profit margins. Weak customer retention. Another major issue was Big Lots' failure to build a strong customer loyalty ecosystem. Unlike companies like Costco or Dollar General, which have robust rewards programs and loyal followings, Big Lots relied mostly on casual walk-ins and seasonal shoppers. When consumer behavior shifted, especially during and after the pandemic, lack of a solid retention strategy became a glaring weakness. Customers simply moved on, with no real reason to keep coming back. Lack of innovation as retail rapidly evolved with technologies like augmented reality, driven shopping suggestions, and efficient inventory systems. Big Lots failed to keep pace. Their stores remained outdated, their website was slow and unattractive, and their mobile shopping experience was almost non-existent. This technological lag hurt their ability to compete in a digital-first market. Seasonal overdependence. Big Lots heavily relied on seasonal sales like Halloween, Christmas, and back to school for a large chunk of revenue. While this strategy worked in the past, it became risky as supply chain issues and inflation made seasonal shopping unpredictable. With consumers cutting back, seasonal inventory often went unsold, further damaging their financial health. Leadership. Turnover. One of the major issues that plagued Big Lots was its unstable leadership. Over the years, the company saw a frequent shuffle of CEOs and top executives, each bringing their own vision but leaving before real change could take root. With no consistent long-term strategy, initiatives often started and stopped halfway, creating internal confusion and operational inefficiencies. This constant upheaval weakened morale, stalled innovation, and made it difficult for Big Lots to navigate industry challenges with a unified direction. The current state of Big Lots. By 2024, the cracks had widened into a full-blown collapse. In late September, Big Lots officially filed for Chapter 11 bankruptcy. Hundreds of stores are now facing closure, leaving thousands of employees jobless and landlords with vacant retail spaces. Suppliers, too, are struggling to recover unpaid invoices. Although a private equity firm stepped in to save the brand, the deal quickly unraveled. A last-minute rescue effort preserved a small fraction of locations. Only around 200 to 400 stores will likely continue operating. The company has vowed to return to its roots, focusing on discounted closeout merchandise. But trust is low, and many loyal shoppers have moved on to competitors like Dollar Tree, Ollie's, and online marketplaces. Without a bold, focused transformation, Big Lots may soon become just another name in the retail graveyard. What happens next? The rise and fall of Big Lots is a cautionary tale about the unforgiving nature of the retail industry. One day you're expanding, making billions, and opening new stores. Then suddenly, you're drowning in debt and shutting down locations. Big Lots made several missteps, failing to adapt to online retail trends, shifting focus to furniture at the wrong time, and ignoring the need for innovation. These decisions slowly chipped away at a once promising brand. Now, the company faces an uncertain future. A scaled-down version of Big Lots may survive, focusing on its discount and closeout roots. But the competition is fierce, and customer trust is already damaged. Will Big Lots manage to rebuild, Or is it simply delaying the inevitable? Only time will tell. One thing is certain, in today's fast-changing retail world, those who fail to evolve are left behind. What's your take? Can Big Lots make a comeback? Drop your thoughts in the comments below. Oh, UTR. Thanks for watching BizWorld Explorer. We're a go-to destination for deep dives into the rise and fall of the world's biggest brands. If you found this video informative, don't forget to like, share, and subscribe. Until next time, keep exploring the world of business.